Concerned about a market pullback? You think there's more downside risk than there is upside potential? Then the question is, should you hedge any of your stock investments? I've got 3 times that you should. I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so right now, at the time I'm recording this video, we've had a tough year in 2022 and a good start to 2023, but it's shaky. And the outlook is that there's, economic storm clouds right overhead. Will they break up or is it about to storm? We don't know yet. We don't know. Here's the thing. I believe in the stock market and markets long term. I do. And if you do, you should be an investor. And yet at the same time, there's the present is uncertain. It always is. So the way I would frame this is, as far as how the market's going to return over the next day, week, month, quarter, or year, it's a leaf in a hurricane. You really can't chart the course of that, right? It's just unpredictable. Lots of factors go in. It's important to have perspective so you can help manage emotions and make any adjustments if you need to in the short term. But in the short term, it's just really impossible to predict. But the long term, history tells us is more predictable. History tells us over the long term, things are more predictable. That, history says 1 out of every 4 years will be negative in the markets. And yet, after, most years in the market are positive. After a negative year, typically it takes 12 to 18 months for things to rebound. If it gets worse than that, then, the market's usually positive after 5 years. A lot of the time, almost 99% is positive after 10 years. And so I believe in the markets long term and yet know and feel comfortable that it's uncertain in the short term. So if you think that uncertainty in the short term, at least right now, or maybe at all times, that the uncertainty or the downside risk, there's more chance of that happening than there is upside potential. We'd all be thrilled if there was a lot of upside over the next year, but it feels that there's more risk on the downside. Then the question is, should you hedge any of your stock investments? And in certain cases, I would argue, yes, you should. I wouldn't hedge everything. But in certain cases, for diversification or for a portion of your dollars, I would hedge. Now, what are some ways that you can do that? And I would argue that hedging isn't, I'm going to get out of the stocks or I'm going to take 50% of the money out of stocks and just put it in cash. No, that's not hedging. That's making an investment allocation decision. That's a change of risk tolerance or possibly speculation in the short term. Hedging is a few different ways. Is one, you're buying some options, some individual options on, and basically, if I hold this investment and if the investment goes down, I've got a put option that I've paid for that I can sell those investments at today's price or at a particular price, even if the price drops. Even if you don't want to sell your underlying investment, that put option will appreciate in money and that can help hedge, that can help offset. You can do that on an individual stock, you can do that on the overall stock market. There are also other instruments out there that help you hedge. We use an exchange traded fund that helps hedge the overall markets and so on. But the underlying chassis is options, stock options. And that's a very complicated type of investment. And to work with the CFP, and I wouldn't speculate in there, but it's really designed to help hedge a stock or stock position or the overall stock market. So when are there times where you may want to hedge? And again, this isn't going to be a blanket recommendation because options in and of themselves are very risky and speculative. And so I'd encourage you to work with a professional on this, work with your CFP to see how you should hedge or if you should. But when are some of the times when you may want to consider it? Well, one is you're right on the cusp of retirement or you're in retirement and you're in this season where there seems like there's more downside risk than there is upside potential. Now, if your entire investment portfolio is just all mixed in together and you're at retirement, then I think hedging is probably going to be appealing, but I would also say you may not have the right investment approach. By the time you're at retirement or near retirement, you need to know, all right, here's how much money I'm going to be withdrawing from my investments in the near term. Therefore, of my entire portfolio, here's the short-term money. You need to have that position for the short term so that you're not worried about ups and downs of the market in the short term. Here's the money I need over the intermediate term, 3 to 5 years, and then here's the long-term money. And with the long-term money, do you need to pay for that hedging? Do you need to give up some upside or make some, or pay a premium to buy options for money that you don't need for the long term? You probably don't, but at retirement or in retirement, that's the times when you may want to look and consider doing some hedging, even if it's just a mild form of it. Second time you should hedge or consider it is even for long-term dollars, or if you're not yet on the cusp of retirement, but you're maybe 55, something like that, and you're seeing some risk within the stock market and you're not sure you're going to be able to ride through it. Right? I've seen lots of people with fantastic investment strategies bail at the wrong time because they just don't have the stomach, or they feel it's different this time, or they get so nervous, they get so concerned that they saw a period where a great investment strategy didn't work temporarily, and they changed things, or they bailed at the exact wrong time. If you get on a roller coaster, the last thing you want to do is jump off while the thing's moving. Jump off on the way down. No, you do not want to do that. So are you strapped in, in the harness and willing to ride this roller coaster? If you're not, then you may want to consider hedging or a portion, a chunk or a portion of your dollars, so that yeah, I've got a belt and suspenders on. Sorry to mix metaphors here, but I've got some built-in protection that will help me ride through the volatility in the short term and stick with the overall strategy. And then a third time when you may want to consider doing some hedging, and again, work with the CFP on this, is if you own a large portion, a concentrated position in an individual stock. So say that you inherited, and I've seen this before. It's obviously can be much more than this, but grandma and grandpa owned an individual stock because 80 years ago that's just what they did. That was then inherited by mom and dad. They've just held it because that's what grandma and grandpa did, and it's done really well, and now you inherit it. All of a sudden you've got $800,000 of an individual stock. The overall stock market, say the S&P 500, is 500 companies. So if one of those struggles, or if one of those goes belly up or something like that, it doesn't impact the whole significantly. But when you own one individual stock, if that company changes CEO, if their industry gets under fire, if they have a malfunction, or they've got an issue with one of their products, or it's just poorly managed and the thing goes bankrupt, you can lose a significant amount of money in just a short period of time if you've got to concentrate, a lot of your wealth is concentrated in one individual stock. Think of this like your house. You've got a house that's worth, say, $500,000. You're paying homeowners insurance just in case that thing goes up in flames. And yes, you'd need to replace your house. You wouldn't necessarily need to replace a stock, but as far as net worth value or asset value would still be lost. So you're willing to pay $1,500 or $2,000 a year in insurance premium, not because you hope your house burns down, no one wants that, but that just in case it does, you can rebuild it. So with that concentrated stock position, should you consider paying a little bit every year to buy a put option just in case that stock drops significantly? You can help hedge and offset some of that. That's another time when you'd want to consider hedging. Overall, guys, I'm a believer in the capital markets, long term, absolutely, and I just know the short term is always going to be unpredictable, and I get it. Right now, don't fight the Fed. The Fed has been trying to slow the economy down and slow down speculation in hopes to manage inflation. So I get it. The outlook isn't too rosy, yet the stock market at all times moves to make a fool out of as many people as possible. So you do just never know. If it makes sense for you to hedge, work with your certified financial planner, because I wouldn't want to make that decision in a vacuum. You're gonna want to work with someone who's looking at all 6 areas of your financial life and helping you know whether you should put some hedges in place, how much, and what type. Work with your CFP on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.